Imagine if you could spare $100 a month. That's a little over $3 a day. It could be as simple and easy as not going to get your daily coffee from Tim Hortons. What if you could take that money and turn it into over $1 million? Well, I'm here to tell you that you can do just that with mutual funds. Mutual funds invest in stocks and bonds. Bonds is basically lending out money and having it paid back with interest. A stock is a share of a company that you can buy to be a part owner. You can then sell your stock later for a higher price if the company has gone up in value. But it is important to know that stocks have a very high risk of dropping in value, sometimes even going out of business, which would leave your stocks worthless. Thankfully, there's a way to invest in stocks and bonds without nearly as much risk and grow wealth. That's where mutual funds come into play. A mutual fund is a big pool of stocks or bonds that are normally picked by experts from the company that runs the mutual fund. Every mutual fund has their own objective, and they normally have higher rewards with much less risk. Investing is very critical to growing wealth and for your retirement. For example, one of my favorite mutual funds is called the Fidelity Contra Fund because it has such a high average return rate. So here we have the Fidelity Contra Fund. I got this chart out of the Dogs of Dow website, and it's the last 20 years, since 2000. It has a life average of 12.5%, meaning as long as it's been around, it's had an average return of 12.5%. So, if I went back to my beginning example of 40 years, and you consistently contributed $100 a month, and it continued to have the 12.5% return, it would grow into $1.2 million, having a total contribution of $48,000 of $100 a month, which is pretty crazy. That's a lot of money. Money that is in your savings account is money that is not being made. And yes, there is risk involved, but you can find a less aggressive mutual fund that will fit your needs. Now, let's take a look at some of the many types of mutual funds. Here's an index fund. Index funds follow the market, such as the Dow Jones, S&P 500, and the NASDAQ. So if you invest in these, and you look at the market's going up, your money goes up. If the market's dropping, your money is dropping. Then here's growth funds. Growth funds are more aggressive, they can be, or there's less aggressive ones, but they can target specific sectors such as healthcare, technology, and be more specific and pick ones. And you want to pick ones that try to beat the market, and there are ones that beat the market. Those are the ones that you want to get in. Then there's balanced funds, which kind of spread their shares around. They invest in hundreds of companies, so they spread, some in healthcare, some in technology, some in communication. Then there's target funds, which are great for retirement. So say if you have a target fund for 2065, as you get closer to that retirement date, it takes a lot of your stocks and moves them slowly into bonds, which are generally safer. So how can you invest in mutual funds? Well, you can try to choose one by yourself, but make sure to do the research and find a mutual fund that fits your needs. If you are near retirement, then maybe you will want one that has smaller growth but less risk. But if you're younger like me, and you don't see retirement for at least another 10 years, I would suggest some more aggressive ones with higher return averages. But if you want help, you can meet with some financial advisors, and they are very eager to help you. But if you don't have any, there are some companies out there that are also very eager to help you, such as Morgan Stanley, Charles Schwab, Fidelity, and many other local firms around the area. One of the most common mistakes in investing in mutual funds is investing emotionally. Now here's the S&P 500. I got this off of MarketWatch.com. Since 1994 to 2015, the last 22 years, you can see the market goes up, and the market goes down, and the market goes up, and the market goes down. So hold onto your funds. Now make sure to contribute the average monthly contributions and put in your budget, because that works nice. So that way you're getting a good average of when you're investing up and down. So in 2008 here, you can see the market dropped. A lot of people panicked and sold, which was not a good idea, because in 5 years, it rose right back up again. So hold. You can't guess the market. If you try to guess the market, then you might end up losing money, which is not what we want here. So hold on to your stocks and add monthly contributions. But I want you to know that you can do this. It's not rocket science. Just make sure to do the research and do not make emotional decisions. You also do not need a ton of money to invest. If you just invest small amounts of money, but you do it consistently through contributions, that'll work also. Just be smart and invest in mutual funds, making your money work for you.